Wall Street is feeling quite universally bullish entering 2025. Now, you obviously want to take this with a grain of salt. Short term forecasting is proven to be nearly impossible. Wall Street expected 2024 to be a pretty down year, very modest expectations for stocks, very low expectations for growth, and we tremendously outperformed both. Additionally, Wall Street has far more bearish long term forecasts for US stocks. In fact, most firms think it will underperform bonds over the next decade. So let's break down all these quick 2025 projections in this video. My name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. So, what does Wall Street see going into 2025? First of all, the average firm, this is from a Bloomberg kind of consensus surveys of all the different Wall Street firms. Average firm is looking at an S&P 500 target around 6,600. That represents over a 12% gain from where we ended the year, about 5,881 or so, end of 2024. So over a 12% gain. Now, historically, stocks have returned around 10% on average in the US. That earnings per share estimate, you'll see at 269, that is also about 12% growth in earnings. Historically, earnings have grown closer to 7%. So again, they're expecting outperformance relative to history of both stocks and earnings. Now you can see we go as high as 19 and 20% from some firms, Oppenheimer, Wells Fargo, and some of the outliers. There's only three firms predicting below average growth. So UBS, BNP Paribas, and Cantor Fitzgerald. Cantor Fitzgerald is really the only, quote unquote, kind of bearish one at a 1.9% percentage gain. Let's compare that to last year. 1.9% gain was actually close to the average gain predicted for 2024. So if you look at this chart, you'll see the average target for the S&P 500 for 2024 was 4,861. The far right here, the S&P 500, this shows a value of 6,090, but this was taken before year end. Like I said, S&P 500 ended the year at about 5,881, and its total return, so including dividends reinvested, was around 25%, just over 25% for the year. So that 4,861 represented only about a 1.9% gain. As you can see, many firms were quite bearish entering last year. Very few expected the significant gains we got. Almost no firms expected even close to historical average, and every single firm underestimated just how much the S&P 500 grew last year. Very few times in history has the S&P 500 gained 20% in back-to-back years, which is what's happened in 2023 and 2024. Unfortunately, that's not always good news. A lot of those have coincided with poor 1 and 2 year forward returns, although the late 90s, for example, saw still positive returns for a couple of years. It's not just Wall Street that is bulled up right now. Main Street America is also feeling pretty optimistic. If you look at this chart, it comes from the conference board and put together by Bloomberg. A record number of American households expect positive returns in stock prices over the next year. And that's bleeding into the way that they're investing as well. So if you look at the average household allocation to financial assets, equities are at or near an all-time high level. Only other time they were this high was 1999. So tech bubble, maybe not your best comparison. So not only are houses reporting feeling bullish, but actually these more quantitative metrics are showing that they are allocated super heavy to stocks right now. So everyone's kind of predicting outperformance next year. That's something that I find maybe a little bit concerning. Like I said before, some of these short-term forecasts, they're better gauge of sentiment than they really are in terms of any true predictive value. Basically nobody has proven any ability to predict stock prices in the short run. And Wall Street is actually contradicting itself. Many firms have put out recent research projecting really low future returns for stocks. So they're looking at a 10-year time horizon. And multiple different firms are predicting US stocks to underperform bonds over the next decade. The forecast that got a lot of kind of traction was from Goldman Sachs. They predicted that over the next decade, stocks would return 3%. That was their baseline. And they gave a range of -1% a year to 7% a year. All of those would be below historical averages. That 3% number would really mess up a lot of retirement portfolios and projections that people have. And if you kind of break down the way these forecasts are done, valuation is a huge driver, and stocks today are at or near their all-time high valuation levels. So that's going to be a real headwind to 10-year returns. And it's not just Goldman Sachs predicting this. You look at this from Morningstar, they're projecting a 3.3% annualized return over the next decade. Both of those, the 3.3 and the 3, that's below, say, the 10-year treasury, which has been getting close to 5% recently. And these guys aren't alone, too. You just look at Vanguard, they've been projecting a 3.8% return over the next decade. I've seen many other valuation metrics that are predicting low single digits, call it 2%, 3%, some in the negative territory. To me, it doesn't really matter. We don't need to know the exact number to know that, hey, there's a pretty bearish forecast for US stocks. So, something you may want to consider in your asset allocation. But hope you found this all interesting. I think it's always a nice to check on sentiment of Wall Street. Interesting to me that they were so bearish last year, and yet we went on to have a fantastic year for US equities. Now they're so bullish this year. Does that mean we're going to have a bearish year? Not necessarily. We could certainly outperform their metrics and have another 20% up year. Of course, I'm super worried about valuations and long term returns, but it's just nice to check in on where sentiment is at. So if you like this video, I encourage you to share it with anybody you think would benefit. Subscribe to my channel, and I appreciate you tuning in today. Thanks.